once you get this airplane off the ground, you can hardly stop it. It's going to keep going more and more efficient, better and better, no matter what. This is how that exponential curve gets built.
Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of Thrivewell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place.
Welcome back to the Bankless by Design podcast. I'm Tricia Miller, and this is part 2 of our conversation on dividends as we walk through becoming your own banker. In the last episode, we talked about what dividends are, how life insurance companies determine them, and why the dividend rate alone is not a sound way to compare companies. But today we're going to build on that by talking about what actually matters when choosing a company and designing a policy for the infinite banking concept. So, let's jump back in. So the point is, do not make decisions on a policy purchase or a certain company based on the dividend rate alone. It's not a sound way to make a decision. So instead, how should we? Well, what we should be focused on when choosing a company, especially as it pertains to a policy design to help you take over the banking function in your life, well, most importantly is your behavior, the behavior of the owner. And of course, we saw that in the previous section here where Nelson talked about the car analogy. One person can get 200,000 to 300,000 miles out of a car, depending on how they treat that car, versus another person who can't get 50,000 miles out of the car without it falling apart. So the behavior of the owner matters the most. It is more important than any of these other factors. Are you consistently paying your premiums? Are you paying them to the maximum? If you're taking out loans, are you repaying them back with at least the interest charges being paid? Are you redlining the policy constantly by taking out every single penny of cash value and putting pressure on that policy? Nelson talked about this. Eventually, that kind of activity is going to catch up with you. So your behavior matters the most. The second thing is a good, solid company that has more than 100 years of profitability and sound financials. And you can look at their financial sheets. The third thing is that you definitely want to have a mutual company where you get to participate in the dividends. I've already mentioned a non-direct recognition company, especially when you're using it for the infinite banking concept. But also, you want a company that is friendly to the infinite banking concept. Not all companies are. They haven't built their products in a way that are flexible for someone who's going to use it for the infinite banking concept. So you also want to look at the flexibility of a company's riders and how the mechanics of those policies work. But also, I believe it's really important for you to have a good coach with good service. You need someone who's all in on this and is going to answer the phone when you have questions, who is not going to be your banker for you. No, you are becoming your own banker, but is going to be one who's going to be willing to walk with you through the learning process and help you implement this in your own life and your financial picture. It's going to be able to sit down and strategize with you and just help you along until you have gotten to a place where you have figured this out. And you also want someone who's paying high premiums themselves. Are they actually practicing the infinite banking concept themselves? Are they putting their money where their mouth is? All right. Now back to our scene on John Doe's policy. He has had it for a few years, and the directors have asked the accountants, how did we do on John Doe's policy this year? The accountants report that they collected $1.10, just like they were told to, but after calculating all the aforementioned factors, they found that it took only 80 cents to deliver that promised death benefit in the future. This means the directors can make a decision with 30 cents. If they are halfway smart, and Nelson says most of them are, they will take into consideration that they need to put part of this into a contingency fund to prepare for unexpected future risks. Again, here they're being very prudent, good stewards, and diligent with the way they are managing the money. So they put 2.5 cents of that 30 cents into the contingency fund, and then they distribute the other 27.5 cents, and they call it a dividend. Most people have the impression that this is a taxable event. This is not so. Remember, the income tax has only been with us since 1913. The U.S. got along very well without it prior to that time. There were surpluses in the budget, Nelson says. Hard for us to imagine it, isn't it? And life insurance has been around for over 200 years. So long before the IRS even existed. The word dividend was used by the insurance industry to describe this dispersal, and it stuck with us. But the correct classification is a return of premium or a return of capital, which is not a taxable event in IRS terminology. If the owner uses the dividend to purchase additional paid-up insurance, and he puts in parentheses, no cost for acquisition, sales commissions, etc., the result is an ever-increasing tax-deferred accumulation of cash values that support an ever-increasing death benefit. And there are no government bureaucrats looking over your shoulder telling you what you can and cannot do. That's freedom, folks. The result is limited only by the imagination of the policy owner. Okay, so back up a little bit. The dividend is not taxable. And in fact, it contributes to the cost basis of the policy. So here we have the ability to accumulate dividends tax-free, compound them tax-free, and pass them to your heirs without probate, by the way, tax-free. Now, I know he says here tax deferred, and that may technically be accurate. It's tax deferred. But if we are going to follow the infinite banking concept, all of this is going to end up tax-free because we are not surrendering this policy. But doing this, we are avoiding one of the greatest headwinds that we face. One of the greatest drains on our wealth is taxes. Tell me where else you might be earning money or dividends or making any kind of income of some kind that is not taxable. But again, Nelson reminds us that the IRS has only been with us since 1913. And you'd be surprised how many people do not know that fact. They just assume the IRS has been with us since the very founding of our country. But that is not true. So here we see life insurance has actually been around for over 200 years. In fact, I did an episode on this, and my research was that it was in the early 1700s that we had the very first origins of life insurance in the United States. But unfortunately, we have now had the IRS with us for the past 113 years. Suffice it to say, Nelson knew the severe headwinds that we face with taxes and inflation, which is also a hidden tax. When they can't get enough tax directly from us, they inflate our money, make it worth less in our pockets, and they receive more. And then, of course, there's third-party interest from banks as well. Here we see, by creating your own banking system using dividend-paying whole life insurance, Nelson is giving you such an advantage in your financial welfare. I cannot encourage you enough to take heed to his words. And while I'm at it, read the books he recommends in the back of this book. Dig through this book, get through this one, read the other one that he wrote, Building Your Warehouse of Wealth, and then read the recommended reading in the back. There is a whole education here beyond the college level if you will take that challenge. And he didn't just put those in there for giggles. All right, back to the text. The insurance industry has used the word dividend, but the IRS has classified it as a return of premium. And latching on to that classification, there are financial gurus or financial entertainers, shall we more accurately say, out there. And the reason I say financial entertainers is because they are not financial professionals. We listen to them as if they are financial professionals, but they are not. They are strictly financial entertainers selling books. They will say that the greedy life insurance companies, when they call it a return of premium, just overcharged you. So your dividend is just really giving back to you the money that you overpaid, and it's a terrible investment anyways. Well, I'm going to challenge that for just a second. Coca-Cola is charging you more than they need to for a Coke so that they can make a profit. If they didn't charge you that much, they wouldn't make a profit. And if they didn't make a profit, they wouldn't have the ability to pay their stockholders a dividend. The only difference here is that you might be purchasing a Coca-Cola and not be a stockholder, so you didn't get to be on the receiving end of the dividend. Somebody else did. Well, that's different from the life insurance company doing what they need to do to be sure that they are profitable, being very conservative. Only the difference is you happen to be the consumer of the life insurance company and part owner. So you get to receive a portion of the profits when they're profitable. So all I can tell you is I am happy the IRS classifies it as a return of premium so that it is tax-free. I am happy to receive a dividend that is going to add to the compounding growth of the asset that I own. And I don't care what you call it. Give me the dividend. Besides, if it was true that they were only returning my money that they overcharged me for, then how is it that 20 to 30 years down the road, when I have paid $300,000 in cumulative premium, that's the total amount of money I've put in over 20 to 30 years, that I now have more than $750,000 in cash value and a death benefit going to my heirs of about, I don't know, $900,000, maybe $1 million? I don't think they were just returning an overpayment to me. So call it whatever you want. I'll take the dividend. In fact, Nelson goes on to explain how some of that compounding works that I was just referencing. If we move on to top of page 23, he says, if the owner uses the dividend to purchase additional paid-up insurance, the result is an ever-increasing tax-deferred accumulation of cash values that support an also ever-increasing death benefit. So right there is how this is actually growing to an exponential curve. He's showing you your dividend when it goes into a paid-up addition, which is paid-up additional insurance. When we design a policy for the use of creating a banking system with the infinite banking concept, we're going to elect that the dividend goes to the paid-up additions to purchase more paid-up additions. Why? Because a paid-up addition is another block of death benefit that is fully paid up. And you'll notice that he put in the parentheses at no cost for acquisition. So when the dividend goes into paying, into buying another paid-up additional chunk of death benefit, it goes in every dollar for dollar to the cash value. And every dollar goes toward that death benefit, as opposed to the PUA that you might pay out of pocket every year to that portion of the policy. That has a cost to it. But the PUA that is purchased by the dividend has no additional cost or fee. 100% of those dividend dollars goes to pay for that fully paid up block of death benefit that causes the cash values to rise in an ever increasing manner. So while some people say the death benefit, they don't care about the death benefit, you can't have a rise in cash value without the death benefit. So you want to ever increase that death benefit by buying these paid up additional blocks of death benefit that go on top of the original face value of the policy, the base premium, increasing the death benefit continually. And then the cash values by contract, guaranteed, must chase that death benefit and reach that at 121. So you can see that as you're making the death benefit rise higher, it forces the cash values to rise higher. And that's all by guarantee. So you will be buying paid up additions in this policy yourself out of pocket, but now you also have dividends that are coming off of the paid up additions portion of the policy, as well as the base premium, as well as the paid up additions that have come from previous year's dividends. Now you have several sources of death benefit that is now creating new cash value and creating new dividends that are buying more death benefit that is creating more cash value. And so you can see it's like that flywheel, or like Nelson talked about earlier about the airplane. Once you get this airplane off the ground, you can hardly stop it. It's going to keep going more and more efficient, better and better no matter what. All right, this is how that exponential curve gets built. Now, you do have other options for where to put your dividend. I don't recommend them, but you could, just so you're aware, you could tell the company to send you that dividend to you in cash. I want a check in the mailbox. I want direct deposit into my account every single year. Okay, you get that dividend. You do whatever it is you're going to do with it, spend it, it's gone. Or you can elect to have that dividend reduce the premiums. Let's say you're tired of paying a big premium. You're like, I don't want to pay that big premium anymore. So you can ask the insurance company to take that dividend and reduce the premium for the coming year. That's another election. Another one that you can do is you can ask the insurance company to hold the dividend at interest. And now, again, it's taxable and it's outside of the policy. It's not contributing to the growth of the policy. And there's even some companies that can have you use the dividend to help pay back loans. But I would submit to you that there are other ways to handle that. None of the elections are as efficient and contributing to the growth of your policy like it is when you put the dividend election to paying paid up additions. And why wouldn't you want to do that? Don't you want to make this a fantastic engine just rolling down the tracks faster and faster, bigger and better every single day? Well, that's what I would want to do. And if you work with me with the infinite banking concept, I think that is what you also would want to do. But even Nelson didn't do it. So let me read to you the next paragraph, very thing. He says, by the way, these dividends can get pretty significant over a long period of time. I bought a policy from a major insurance company in 1959, and the annual dividend is over 10 times the annual premium now. Can you imagine? You pay a premium. The dividend alone, this isn't even the increase in cash values at interest. This is just the dividend, is over 10 times the amount he's paying in premium. They would have been much larger, here's where he admits this, had I not used the annual dividend to reduce premiums for the first 15 years. These things are just not adequately explained by life insurance sales folks because of the limited understanding of their home office folks that teach them. A pity, he says. So Nelson used his annual dividend to reduce his premiums for the first 15 years. He simply didn't realize. He says things were not adequately explained. And of course, initially, Nelson's thinking was like everyone else's until he had that epiphany when he was in a major crisis financially. He said, like everyone else, you want to pay as little premium as possible for the most death benefit. So why wouldn't you want to reduce the cost of your premiums? Because you're looking at it as a cost. This is how we ordinarily think. Well, clearly, Nelson had to learn to rethink his thinking, and so do we. Even still, even with his policy, he made mistakes. But his 1959 life insurance policy, despite 15 years of doing that, his annual dividend was over 10 times the annual premium. When he wrote the book here in 2008, so what is that, 49 years, I believe? Yes, 49 years later. So it would have been much higher had he not used them to reduce his premiums. Now, I know hearing the year 1959, even to 2008, that sounds like a very long time, 49 years. It's a significant amount of time. But time is going to pass no matter what. We might as well take advantage of the time that we have left, no matter our age. We can't do anything else. We can't take advantage of time that's already passed, but we sure can take advantage of time that is in front of us. So what are you waiting for? It's a good question, isn't it? If you're ready to get started, there is absolutely no time like the present. Don't let more grass grow under your feet. Get a copy of the book if you haven't already. Reach out to me at banklessbydesign.com and book a 30-minute consultation with me. I would love to have a conversation with you and see how we can apply this to your life and to your financial future. I hope you have enjoyed this episode. I hope this has been educational. If so, give it a like, share it with someone you love, and leave me a comment or a question. I am so happy to respond to any comments or questions that I might get. And until next time, have a great week. Thank you so much for listening.
Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.